Hi, and welcome to this new segment by ETF Junction, where we have been talking about what ETFs are, how you can get into ETFs. But I think it's important to know what are the options out there. So, this segment will take all these options one by one and try to demystify this space and the options that you have. Now, just to give a little background, which we've always been talking about the ETF and the passive market space, both the global and the Indian markets have been growing by leaps and bounds. The global markets have crossed almost $11 trillion, and India is heading for its first 100 billion in the passive space. So, this opportunity is a treasure trove that is still being discovered. Now, to provide a little reference to all the audience at ETF Junction who are very, very new to the word passive investment ETF, you're basically investing in an index, which is a basket of securities that can cut across all asset classes. So, whether it is the Sensex 30 stocks or the Nifty 50 stocks, you can invest with a small amount as little as 500 rupees. So, these different forms of investing and how this can be an advantage to you and in your investment journey is what we are going to be discussing today. And while there are so many different products, there are more and more options coming up. So, this is why we have got today Umesh, who is the national head for ETFs at Mirae Asset, to help us understand this space and all the new options that are coming up. So, welcome, Umesh.
Yeah, thank you, Koel, and thanks ETF Junction for having me here.
So let's kickstart this, Umesh. Let's begin with a basic understanding of what passive investment is, and especially how ETFs can form an integral part of the investment portfolio.
Yeah, in globally we have seen. I'm sure you started the this session with your thoughts on the global markets, which clearly evident that the passive is something which is now started already taking the center stage, and in a country like India, it is clearly evident that investors are now getting bit of interested into this kind of these kind of products. So basically, passive investing happens, and globally also, if you look at the trend, it essentially starts when actually markets start getting mature. And the moment you move towards from a developing market to a developed market where the number of participants go up, your price discovery which you always look for into, especially in a country like India and across the globe, that that options those opportunities goes down, then obviously the underperformance into the actively managed funds is quite evident in some of the pockets. So we have seen in India also lately it is quite evident in large cap, and last year we saw that in the mid and small cap also the similar kind of underperformance is quite evident. This is where actually investors are now more keen towards passive, and they have started talking about it. When I talk about passive is essentially an investment vehicle which basically allows an investor to invest into indices or into a market without on a rule-based approach, right? So there are two ways to look at the market. Either you beat the market or you meet the market. So in that sense, passive investing is basically meeting the market to get you that kind of beta which you look for from the market. So it's essentially a rule-based investing where the objective of the scheme is to make sure that the constituents of the underlying index are already part of that passive products on which the product is being launched, and it should be in a similar fashion in terms of asset allocation, in terms of percentage weightage, and then the objective of the scheme is to replicate the underlying index. As actually the idea is to give you the returns as compared to active funds, where traditionally in a market like India, investors are more keen, and we have witnessed where we are getting decent alpha. This is a different approach which gives the client's portfolio some kind of cost benefit, some kind of returns, and obviously there are multiple ideas on passive. When it comes to passive, you can invest through ETFs, which is exchange traded funds. You can invest through index funds, which are all similar to exchange traded fund, but there is in an index fund you need not to have a demat account. And there is another way of investing into passive fund is through fund of fund, which is basically a product which invests into underlying ETF, and but the investment happens through mutual fund route only. So in India, it is slowly and gradually picking up, and I think in investors, especially the new age investors, are already understanding the benefit of passive. And I believe that going ahead in a market like India, it will grow the way we are seeing in globally the trends are happening.
Absolutely, Umesh. Now, obviously, in India, where almost 17% of the total assets that are there in the industry are now with passive and growing. So there is only one way that this space can grow, and that's up. And I've always been an advocate for that. But you spoke about, passive being, access to the index-based returns. Market return is something which a lot of people have understood. So market-based returns is something people can correlate with the Sensex and the Nifty. But there is a growing interest, and the investors always seek differentiated returns. Some people call it alpha. Some call it, more different kind of returns compared to market returns, different strategies. Now, smart beta is a word we've been hearing a lot. So what is so smart about this, and what are the different kind of strategies in this segment?
Yeah, I think that's a really happening in the Indian market as well as globally also. When you talk about smart beta, there are essentially two kind of factors. It's basically factor in investing, and there are two kind of factors which mainly broadly, if you look at, one is your what you call it. It's a macroeconomic factor which essentially gives you an idea about say market risk in terms of your interest rates, your economic data points, and broader at a macro level, it gives you an idea about the about some factors, right? And another factor is a style-based factor. So the style factor, which we talk about, which explains actually and gives you returns and risk of a specific asset class. So one factor is at a macro level. Another factor, which we call style factor, is basically at a specific asset classes, right? So when we dig deeper and talk about more in terms of factors or smart beta, then comes multiple factors, starting with the value factor, or a say quality factor, alpha factor, momentum factor, dividend yield factor. And I think the list is quite long, where you can say that there are multiple factors are being discussed, and the way market evolves, I assume and I'm sure that there will be new set of factors will also be evolved with time with the market behavior. So factor investing is basically, if I have to summarize in the layman language, it is basically an idea to invest through a passive route into a specific segment, into a specific asset class, or a specific set of, say, market cap or something, and to garner returns out of that. In some cases, there are chances you might generate alpha also over and above the underlying plain vanilla index. Because when you talk about factor, you are basically creating another index which is on the base of the parent index. So, say, to give an example, if I have to run a factor, say dividend yield factor, over and above say Nifty 50, so I'll create another index which is based on this factor of dividend yield, and the parent factor will be Nifty 50. They're quite possible if the factor behaves well, quite possible that the newly created index essentially will outperform, can outperform the underlying or parent index also. So it is basically getting more deeper into the market and trying to differentiate stocks into different factors. And also every factor has a different you can say use according to different market cycles. There are factors which works very well in growing market, bear market, bull market, sideways market. We can see there are multiple cycles of market. Every factor has a different characteristics. So smart beta is basically something which is little smarter than what we have done. It is like being active within passive in a way.
Yeah, so sounds like this is like you take the universe and overlay it with a lot of factors, which could be also things that are used by active strategies, and you make them rules based, and thereby it becomes a passive strategy, which then allows you to get those differential returns which you would probably want, which is different from market returns. So
Correct.
fair enough. I think that I think explains it. But let's take it to the next level. You have all these different factors, okay? And our investment strategy, of course, moves across asset classes, moves across different strategies. So how does this smart beta make a difference to somebody's portfolio or investment strategy?
Let me talk about first how the difference in terms of normal strategy or a smart beta strategy. I think this will answer that question. So basically, when I talk about say normal investing or traditional way of investing, where we have been investing into an underlying, there is a benchmark. Against the benchmark, fund manager creates a product, and as per regulation, certain percentage or minimum percentage of that amount should be invested into that particular index, and rest fund manager has an option and freedom to move away from the index and can change the strategies depending upon market conditions. Whereas in case of a smart beta or a factor investing, it is, as I said at the start of it, this is a pure rule-based investing where the rules are predefined. If the rules are predefined, it means that if the market changes or market scenario changes, the rules will not be changed. The index, which is based on a specific rule, will be focused on that particular rule only. Sorry, like to give an example, like say Nifty, we create a say index. Say okay, over small cap, we create an index, and we want to have 100 companies on the basis of say different factors like liquidity, quality, momentum. So basically, we will follow a rule which will allow us to select those 100 companies on the basis of these three parameters, so that investor can enter into a space where the stocks are being selected on a predefined rule. Whatever is the condition in the market, that particular index will move on on rules only. So we have seen in lately that sometimes if market changes and you change your strategy and then market comes back, then sometimes we have realized that strategy goes wrong. But if you investing through a rule, then the chances of continuing with that rule, and since you are continuing with that rule, your market will revert back, and then your overall portfolio will stay what investment horizon you kept and what goal you were invested in. So this is a kind of approach which gives your portfolio more disciplined way of investing as compared to the normal way of investing. So as this can be a mix of active funds versus these kind of strategies which give you a good balance to your portfolio.
So fair enough. I think, a disciplined approach and, kind of creating a more efficient way to access the smart beta into the investment strategy makes a lot of sense. But looking at the way global markets have been growing, it would be good for, our listeners here to understand what is the kind of market size that's in India in this smart beta category.
If you talk about India market as an overall for a passive space, also it's though it's a very nascent stage, everything is just developing, keep on adding. But if you look at the smart beta space, it is quite exciting to see there is around 13,000 crores worth of AUM is already there with around 52 products in the market. If I break it up, there are 26 index funds already there on smart beta with different strategies, and similarly there are 26 ETFs are also there in the market. If I break it up, the AUM which is 13,000 crore, out of that AUM around 8,800 crore is already there in the index fund with 26 funds, and similarly around 4,183 something is already there as an AUM into ETF space. In last 1 year, there has been a 3,003 crore plus kind of net sales inflows we have witnessed in this space. So this space is slowly and gradually becoming big, and we can foresee that this is the way products are being launched and the investors are interested in these kind of products. This space is has a long way to go.
Yeah, and I can tell you that I've been in the markets long enough. It's so encouraging to see that smart beta is a concept that today people are taking into want to learn. And the market, passive market has moved from just market-based return products into smart beta because this is the kind of growth that global markets have already seen, and they are growing into more and more developed products. But coming back to the factor markets and some of the key factors that we were discussing. You discussed some factors like dividend yield, quality, momentum. I know there is low volatility. And there's a new product that you have launched where you have chosen momentum and quality, which with the universe of the small cap. Now, just for our listeners, momentum may sound and quality may sound familiar to us, Umesh, but maybe for our listeners, we need to understand what momentum is. So just to explain, momentum is basically the rate of change in price movement over a period of time, which helps investor understand the strength of the trend. And quality parameters, you have quality parameters like return on equity, financial leverage, which is through debt equity ratio, and earnings growth. So these are the kind of parameters Mirae has chosen on the overlay of small cap. So can you explain to us the kind of research you did and what drove you to choose this set of factors and the underlying universe for this new product?
So basically, when we talk about actually when we talk about small cap investing, it is always comes with a caveat of okay, small cap are very volatile. They have a liquidity concern. They have a volatility concern. We don't know the business model. We don't know the promoter how what is the experience he has. So these
Right.
are all right questions to be asked. And since investors, especially retail investors, they don't have that sort of mechanism to understand all these things, so we thought of coming out something which can give that comfort to the retail investors as well as the HNIs and other investors also, who can get that idea that okay, if we launch something where the underlying index is Nifty Small Cap 250 index, which is a plain vanilla index. So what we have done is we have put in a factor, actually multiple factors. There are three multiple factors which are we have applied on this index. One is liquidity, another is quality, and third is momentum. We call it LQM strategy. So this is first time we have introduced into the Indian industry in Indian market for into small cap, where we wanted to remove all those questions or concerns, especially from liquidity, quality, and momentum perspective. So we put first filter where we wanted to remove those companies who has or who can create a problem in future towards liquidity. So how we did it, just to brief here, actually we put few filters like we remove those companies who has a listing history of less than 1 year. So those companies we have removed from the index. Second, any non F&O company which has hit, you can say, upper circuit or lower circuit in last 6 months more than 25 times will also be removed. Any company whose promoter has put 20% or more of its stake on pledge, or they have pledged their more than 20% of stake, will be out of the index. Any company who has a lesser average trading value on exchange, bottom 10 companies will be removed. And simultaneously, we did a ratio analysis where the company's market cap along with company's daily average trading value will be captured, and the bottom 10 companies in terms of correlation will be moved out of the index. So with all these put together, we have successfully removed around 50 companies out of 250 index,
Wow.
sorry. So
Okay.
we are left with 200 companies. Then on
Mhm.
200 companies, we put filter of liquidity of quality, sorry. So the quality filter, as you rightly mentioned, when we talk about quality, it talks about return on equity, it talks about debt to equity ratio, it talks about EPS stability. So all three pointers or all three sub filters we put in, and we give them a score. Every stock has been given a score, and then we move to momentum filter, where we looked at 6 month and 12 months risk adjusted return of each and every stock, on basis of which we gave them a score. And then on basis of those scores, those 200 companies, out of those 200 companies, we selected 100 companies which can be better in terms of liquidity, better in terms of quality, and better in terms of momentum, so that investor can have a better experience while investing into small cap. Since it's a rule based, because it's a smart beta factor in investing, so chances of being biased or buying something which is you like a specific stock and you don't want to put that keep that aside. But since if that stock is not coming properly with these filters, will not be part of the index. So this is a very plain vanilla and very straightforward. I must say we have created a product on plain vanilla index, which is a straightforward product investing into small cap. So idea is to give more clarity and some more confidence about small cap stocks to the investor.
Well, that's quite a detailed one. So first, I think whenever you think about small caps, I think credibility of the company and liquidity are the primal concerns that most investors have. I think you've taken care of that through the exclusions. Then over that you have put the caveats of quality and return, and basically rated the entire index and basically measured it up on quality and momentum factors rather than a straight on market cap factor. So I think
Correct.
that is what differentiates the product, and especially I think filters out or sifts out, I would say, the quality and the momentum factors. So now that we've understood the product, how does this benefit an investor? Where should, which kind of investors, and in which kind of portfolios will this be a proper fit?
So basically, when we talk about this kind of product, we have seen lately investors are more keen about small cap because most of there are different kind of investors. There are return chasers, there are quality chasers, there are business model chasers. So every investor has their own appetite, own risk appetite. So this product will be, obviously it's more, since at the end of the day it's a small cap product, so it will be more you can say volatile as compared to a plain vanilla large cap fund, which is a Nifty 50 based index. So from that perspective, investors should look at their risk appetite, risk profile, and if they understand, if they are very comfortable that they are okay with this kind of little bit of volatility in this kind of stocks or this index, I think this is a good product. This is a very good product for a longer period because historically we have seen in last 3 years there have been 20 stocks which became bagger, which became 5x in last 3 years. In last 5 years, there have been more than 24 stocks which became 5x. But for that, you need to have that much of patience, and you need to have into right set of stocks, right set of portfolio. So I think any investor who is keen, who is okay with this kind of volatility and have a longer horizon, I think this is a good product for from their fit perspective. If any investor thinks that okay, I have an active no small cap funds in my portfolio, which is a good thing, but this kind of plain vanilla or rule based investment approaches also should be part of your portfolio. So some percentage of your portfolio, you can always look for these kind of strategies also. So this will help in terms of overall market movement because since this is a combination of quality and momentum, these are two different factors. The quality factors works well when the market is either stable or the bear market, whereas in case of momentum, it works well when there is a bull market. So there are two different market cycles we try to cover when it comes to small cap. So investors should take part of this kind of into this kind of product, which will help in terms of different market cycles also.
Perfect. And you heard it, guys. So you have a defensive and a cyclical strategy, cross kind of using both the benefits of each of them, a beautiful combination. But like, Umesh said, any kind of investment, you have to have the patient, you have to have discipline, you have to see where it fits in your financial journey. And especially whenever you are looking to plan your investments, you have to see the kind of financial status that you're in today, with the kind of journey that you're in, which kind of a stage you're in your life stage, and all that. You have to definitely talk to a financial advisor because they are in a very, very good space to advise you on where and how you should be investing. So always use financial advisors when it comes to taking investment decisions. Thank you, Umesh. This was a wonderful concept, and it's a very interesting one for those who see it as a fit to put into their existing portfolios. That is something that one should evaluate and go look at more information that is available with on the Mirae website on this current new product that is available. So thank you again, Umesh, and thank you everyone for being here and getting a better understanding on smart beta investing.